All right, good morning. It's Saturday morning, October 29th, 2016, and this is the weekly recap. What we're going to look at today is last week's action. So we're going to give a quick glimpse into our closed trades results, all the stats that we have, our weekly zones recap, status of our open positions, and then we'll venture down into the two directional plays that we have for Galafin and our bet that interest rates are going to collapse over the next 2 to 3 years. All right, so let's get right to it. And let me move this over to the screen. Change that. Okay, no change from the last update I gave you this week. So our last closeout trade was on October 25th. So this is just a combined closed out trade status for every trade that I place, whether it's in a paper account, real account, retirement account. So these are just the running tabs of how these trades play out. So no hokey pokey, no, I don't hide stuff. You guys see every trade that I place, and so this is just how they play out. All right, so we're still chugging right along. All right, now let's take a look at the account that I've separated in order to show you guys or showcase to you how to trade an account or a dollar amount and try to double it in a year's time. So we're doing that with the crude. We're trading iron condors in the paper account. I'm trading strangles in my personal account. So they both have the same objectives, trying to double an amount of money in the course of a year. And so far, playing out really nicely. We're up in this account. We started trading it in this fashion August 15th. That's when I opened this up, set it up, put the rules out, and started trading it. So this is the account balance, 33,861. We started with 25,000, so we're up 35% since August 15th. We're right on track with where we need to be with this thing. All right, let's delve into the weekly zones. Hold on just a second, guys. Here we go. Okay. Have a lot of things open here. Have to fish around and find it. Let's close this out, make it a little bit larger there for you to see. Okay, you should be able to see that pretty good. Okay, here's the S&P for the week. You can see we had a downward trend through the week. We tagged the first level going into Friday. That was a beautiful thing. So I really want to see this S&P start moving around a little bit, and that was the first part of it right there. So hey, who knows, maybe we'll get a downside push going into next week. I'll talk a little bit more about that when I get to my S&P futures position. But wow, let me make some spelling grammatical changes here. So there we go. All right, so but again, our levels held. It's to be expected. Historically, these levels will hold over 90% of the time, every week, week in and week out. This week was no exception. All right, let's go to the ZBs. Let's look at bonds. Guys, this thing has been adhering to this downward channel for a long time. Ever since one or two of the bond kings came out and started talking about bonds. So, hey, it never fails. I'm going to talk more about that when we get into our TLT position. Bonds continue to be the most volatile instrument that we follow. And you guys know we watch crude, we watch gold, we watch the dollar, we watch the S&Ps, and nothing compares to the volatility in the bond market. So this thing is continuously piercing that first level at least half the time. I mean, no other market is seeing that type of volatility, but the bond market definitely is. It's actually a good thing. So I don't think that's going to subside. I mean, we're in just a very wild interest rate market where Nobody believes that interest rates are going to go back up again. So, but they're starting, guys, and you know we've been talking about this for quite some time, that the play in the bond market for the next 30 years is to bet that interest rates are going to go higher. So that'll be the basis and the bias for any trade setup that we have that's directional in nature for the bond market. But yeah, we pierced first and second level and closed right below the second level in the bond market. Now, I haven't checked. Let me do this right quick. No, I'll check a little bit later. We'll see when the next bond market expiration cycle closes here. The reason I say that is simply because let me punch it up right quick. Anytime we get a close outside of that 2 standard deviation level, no matter what market I follow, the next week is almost a sure bet on selling a 2 standard deviation wide strangle for a week to go. So let's just check the bond market right quick, and give me just a minute here to check to see when the bonds. Oh yeah, we don't have no juice for a weekly, nothing. Yeah, the next expiration cycle, days to expiration, is 27 days out. So yeah, we just crossed over. That's that line right there. So maybe next time. Alright, so let's take a look at crude. Crude oil is, again, hey, looks kind of like the stock market, huh? I hope we're not back into that, or creeping back into that stage where the crude market's going to follow the stock market, or the stock market follows the crude market, whichever way that was. The traders back in December, January, and February into March were in lockstep with each other. So if you traded crude, you were really really trading the S&Ps. Anyway, I don't want to make anything out of it, but that's the downward track that the S&P took. Crude market breached its first level, no issue there. Second levels weren't in jeopardy. Alright, the dollar had a really nice run up, and then we get some two-sided action. That's what we like to see in two-sided markets, guys. We like to see, we don't really care if a market runs high, keeps going in one direction for a little bit, as long as there's a little bit of check and balance. I mean, it has to be some two-sided action in these markets, not like what we see in the stock market. The characteristic in the stock market, because of all the intervention, is just it makes one-way moves, and then when it gets done, it's done. It makes a one-way move the other way. So, but the moves are extended on a historical standard. So, but anyway, good to see the dollar move up, came back nicely. So, yeah, that's. I just wanted to point that out. We don't care if a market moves up, but yeah, we like to see a little bit of downward action too, combined with that. Gold for the week stayed within our lines, no issues. So last time it breached the level was this big day right here, and since then it stayed right in the goal, between the goalposts for us. Alright guys, here's the TLT, and I'm going to cover what I'm going to do. I'm going to cover the directional play in this one right here. But you guys know that back in here, yeah, when we were in here, this is a weekly chart. So you guys remember me telling you that there's no reason for the bond market to have traded this high. It's just utterly ridiculous. I mean, the world was buying our debt at a unprecedented pace. So those markets were just screaming higher, and no foundation for it other than just it was a herd mentality piling into these things. So it's kind of hard to step in front of that whenever everybody is long those markets. But we continued to buy puts up into these areas, accumulate a put position in TLT, and it's paying off for us. Now our bet's really going to pay off 2 years from now, when interest rates are much higher and TLT price is much lower. So I remember a couple of you asking, when we were up in these levels right here, and it looked like the bond market was never going to turn around. Some of you questioned why I was buying 132 puts. Hey, I told you could buy 132s, you could buy 110s. It's going to get back to those prices, guys. This is complete and utter nonsense right into these areas right here. So I didn't realize I didn't have a pointer until just now, so I clicked in there. But this is the area where we were accumulating, right in this area right here, guys. And then we had that week and a half that just insane, utter, ridiculous move up where everybody was, claiming that the bond market was going to continue to go higher. And hey, look at it. Yeah, like I mentioned here, you hear that hissing sound? Yeah, that's the air coming out of those overpriced bonds. And profits gushing out of the bond kings bond portfolios. Individual bondholders are going to be okay, even if they're buying bonds up in here and holding for 30 years. They'll eventually get their 1% or 2% a year out of the government if they hold for 30 years. But they're going to see probably 60% drawdowns between here and the time that those bonds actually mature, because when these long-term bonds start losing price value, of course they're collecting 1.5–2% a year. The only way they get their money back is to hold until these bonds are redeemed at full face value. So if people are out there buying 30-year bonds, hey, be prepared, man. Your portfolio is going to look ugly between now and then. Do what we're doing. Buy puts. So, but I'm going to revise where we buy puts at, guys. Where we load up again. It's going to be somewhere in the upper portion of this channel, and probably 50% of the pullback from whenever we make a low in the bond market and we start pulling back again. That'll be our cue. We get to that 50% area where we 50% from the high to whatever the low is that we make here. Then that's where we'll start adding to our position again. Remember, guys, and I'll put out guidance for whenever we buy those puts. We're looking out 2 to 3 years, so don't worry about how this thing looks now, next week, next month, or 6 months from now. Our bet's 2 to 3 years from now. We're going to see a huge spike in interest rates and a collapse in bond prices, which will work to our advantage. So let's just be patient, nurse the profits that we have, and I think we'll get an opportunity. The bond market's not going to go straight down from here, guys. It's going to go back up. This is, like I said, a volatile market. And I do expect some upside out of nowhere. It's just normal market behavior. Doesn't mean anything. Everybody's going to put labels on why the bond market's doing this. It doesn't mean a thing. It just means it's a normal market, guys. That's normal market behavior, normal psychological actions from traders and investors. It means absolutely nothing. You don't have to interpret any of that move right there. Again, when this thing starts rallying, the bond kings, the bond bugs are going to come out there and say, see, I told you we're going back. Yeah, we're not going back, guys. I really believe we saw the lowest interest rates that anybody will ever see forever. I mean, guys, I cannot stomp my foot enough and reiterate strong enough how those interest rates, how low those things were relative to anything we've ever seen or anything that's happened in history. So we were there, guys. We were right there. We were right there holding long puts in TLT. Again, this is the interest rates move up. So we were down to 2.1%. We're now at 2.6 and some change. So hey, we still got, like I said, any pull back down into this level right here, and we can start loading back up again. So that's what we need to be prepared for. I'll keep expanding the rectangle here and keep moving it out as a guidepost for us. But anytime we get back close to the bottom of that range if we get back that close. I don't think so. 50% would be maybe at the 2.3% level in interest rates, and that's our call to action to load back up on the puts again in the TLT. Again, this is TYX, the 30-year interest rate market. You cannot trade this. This is just an index. So you've got TNX you could look at for 10-year notes, which is what the world is hinged to. That's every interest rate on the face of the earth is hinged to our 10-year note, which is the TNX. But we're using this to trade the TLT with. Alright, so that's a look at the levels here. So let's pull up here's our stat sheet. Okay, so make sure I have everything filled out. The week of 24 to 28. It's just a quick snapshot again. Again, just to remind you, this is our first level and second level stats. This just shows how many times, what the percentage of times, for example, the S&P closes inside of the first level. So 93% of the time. That's a really strong bet. Again, like I mentioned last week's, once I get maybe 50 or 100 of these observances, that first level may be a very good level to play off of in the S&P 500. So we may change tactics, maybe 6 months down the road. Second level, it closes inside 93.75% of the time. All right, here's what I was talking about, the bond market. The bond market, you can reference a lot of things as far as how volatile a market is, but you need to make sure you're very objective in the volatility. And what comes into play is the IV in those markets, our implied volatility rating. So right now the bond market over the last 16 weeks has broached that first level 50% of the time. There's no other market that's close to that, not even crude, not even gold. Everybody mentions how volatile crude and gold is, but it doesn't even come close to touching the bond market. Bond market closes typically 93% of the time inside of the second level. Here we have crude. It hasn't broached the second level yet. It hasn't closed beyond it yet since I've been monitoring this in real time. So anyway, that's just a snapshot of our stats for how often the market closes inside of our levels. Now another thing that I really like to watch is how often does it touch these levels. So I use both of those as a guidepost, and it helps place trades. And when the S&P is trading like it is right now, I really rely on these stats to place trades. That's why I'm selling what I sell when I sell in the S&P. I've averaged selling puts 3 times a week in that thing, and I use these stats here to help me. But this just tells me that the S&P has touched the second level out of 16 weeks 6% of the time. The bonds have touched second level 12% of the time. Now here's an interesting stat for crude. It touches the first level 68% of the time and closes inside it 68% of the time. So what that tells me is that first level is very significant in the crude market. It'll touch it, but it doesn't close beyond it very often. So again, when we get to those hedge marks that I place in the markets, it's at in between the first and second level. If the crude market goes there and you've got a position on, you really need to respect that position that I put dead center on the chart. So let me pull those up again. Like for crude, if crude were to ever touch that, you can see that. If crude were to ever touch that red level right there in any week, you might want to hedge against it. History has told me that just to hedge and not think twice about it. Don't overthink it. Just react to it. And because chances are, if it goes through that level, it is going to go somewhere between those two levels right there on the downside in between those two levels to the upside. Alright, so that's that. And now let's take a look at trade templates. Alright, let's get things shaped up. Okay guys, here's my S&P position going into next week. I had a strangle on October 12th that expired in 4 days. Well, I had to roll it because it came close to it actually hit the hedge point, so I had to hedge, and as soon as it hit the hedge, the market rallied strongly, like 30 handles off of that hedge point, and I was short S&P futures, so I carried those forward. And in order to offset everything, I've been selling puts against that position. So again, I've been in it since October 12th. I've been in for 3 weeks. These are all the puts that I've sold going into this week. So this week I sold the 2110s against the 2110 short futures that I have. That's the price I'm short at the S&P 500 futures. I collected $900 for next week. Okay, so here's the status of the trade. My trade shows me it being, I know you can't read that, but it's roughly it says $25.99. I'm down $2,599 in this position right here. But we all know that that's not true, because I sold and collected $1,735 worth of premium week 1. I sold $1,842.50 worth of premium week 2. I sold $942 worth of premium in week 3. So I'm going to take you over here to a little Excel spreadsheet. I've collected $4,519.50 in 3 weeks. My position says that I'm down $25.99. I'm really up $19.20 in this trade. Now I just want to remind you, this thing, you know how ugly this thing has looked the whole time. Hey, I've been in this thing for 3 weeks. Okay, 3 weeks in the trade. My profit on this, what I shoot for is $500 a week, so I should be at $1,500 in profits. But I'm not. I'm up $19.20. Now the reason I told you that I'm trying to hold on because of the way the S&P is trading, I've got an absolute chance to kill it. So if next week this market gets a downtick at all and closes below that 2110 level, just to show you, I could roll that $25.99 plus the $900 I collected. Sorry guys, I'm working with one hand here. Okay, it's potentially $5,400. Alright, so at that point, week 4, I should have made $2,000. Okay, I have a little concept in my mind. Now, I've told you guys this is how I've always really gotten ahead in the market, are positions that have gone against me. And when we get two-sided action in a market, you are literally able to crush it and make a lot more money than you normally would if you were just trading the strategy. This is how it plays out. This is the best description that I've ever been able to show you guys. I know you've, over the last 3.5, 4 years or whatever it's been, you've heard me mention that I've always been able to just crush it when I get behind in a position. This is why. This is how it's done. So just keep in mind, this is we don't know how next week's going to turn out. I mean, we're still in a bullish period, honestly, until we get past the 1st of November. That's typically a little short bullish time period in the market, but I'm going to be ready for whatever. So my best scenario best scenario is that we get a 30 handle down push Monday. If we get 30 down Monday, I'm going to unleash the hounds. And I am going to be very, very aggressive at selling puts against this. For not just a home run, not just a grand slam, but for a major coup in this market. So that's what I'm looking at for Monday in the S&Ps. The Goldilocks scenario for me is 30 handles down, and then at the end of the day, sell puts with reckless abandon. So we'll see. We'll see how this all plays out. But this is starting to shape up like markets of old. I haven't seen markets of old in a very long time, guys. Alright, here's our crude strangle and personal account. We put it on October 21st. Crude market strangle, 55 days to expiration. We currently have 47. I think there's a little something going on with the pricing. We're down $400, but there's absolutely nothing to fret about, nothing to worry about. Volatility's ticked up 5% since we put this trade on. That's got a little something to do with it. So I'm not sure what is what's coming out in the crude market that's pushing this thing up. But anyway, we shall we'll just continue riding this thing and trade it as mechanically as we can. Okay, nothing to do here though. Absolutely nothing. Alright, we're getting closer. This is the retirement account. Broken wing butterfly we placed September 26th with 58 days to go. We currently have 27. Beautiful position. So yeah, we'll see. We're getting really close. Maybe next week we'll pull this thing off. But nothing to do right now. Alright, this is the second broken wing butterfly placed in the retirement account. Placed it on October 12th. SPX, 58 days to go. We currently have 41 days. Hey, if you're watching this for the first time, you might say, well, how you keep saying you have 58 days, you put these trades on with 58 days to go. Yeah, put them on at different times, in different expiration cycles. The SPX has, not only does it have weekly options, it has several flavors of weekly options. So you've got plenty of chances in the SPX to put on positions. Anyway, we're in fine shape here, up 670. Beautiful trade. Alright, this is the last broken wing butterfly we put on. We put it on this past week, October 24th, with 60 days to go in the SPX. Of course, it's broken wing butterfly. Currently have 55 days to go. We're down 205. Absolutely nothing to do here. Everything is tracking just as planned. This is the retirement account again, an iron Condor that I have in there. So we put it on October 27th. 43 days to go. Currently have 41. We're down 505. Nothing to worry about. We're in beautiful position. I'm looking to add to this Monday, guys. That will be a new trade. I'll add another tranche in on this and start building up to maybe my full position load. Alright, here's the iron Condor in the crude account. Again, this is the portfolio where we are intentionally trying to double the account value every 12 months. You can use it for your entire portfolio's value. However, one thing I've always cautioned is that I've never ever doubled my account without experiencing 50% drawdowns. So I don't expect that to ever change. We're going to sneak through a couple of doubles without the 50% drawdown. That's just the normal course of statistics, guys, and how things play out. But I think that's the norm. That's what you have to be ready to accept. I'm trading the same approach in my personal account, but I'm not using the whole portfolio. I'm using a portion of the portfolio. So that's what I wanted to talk to you Tuesday night about. Of course, the library was still closed. So we'll harp on that, cover that, and discuss it a little bit at this coming Tuesday night's meeting. How you can shape your portfolio by looking at different parts of your capital differently. So anyway, that's how we stand there. Oh, nothing to go there. Alright guys, I think we are back to, let's see here. Yeah, we're status of directional plays. Alright, so what I'm going to do is I'm going to roll this over, change a couple of things. Okay, this is a weekly look at Galafin. Galafin. Sorry about that. So GLFH. That's the ticker symbol on this thing. Couple of you in class brought this to our attention. It's an interesting play. Regardless of what the fundamentals are, it's just a really interesting play on what these guys do. So I'm just going to talk price action here. So from a standpoint, you can see that we had a nice bump up from 94 cents. I started buying a lot down here at the penny level. I had a lot of resting orders in to buy at a penny. I still have a lot resting at a penny too, because I think it takes a while for this to bear out, guys. Not always, but a lot of times it does. And again, let me put this disclaimer out. I fully expect to lose everything I've got sunk into this trade right here. So I have no visions of grandeur, but I know it is possible that it could happen, that we could ratchet back up. I mean, we're talking back up here is only 43 cents, guys. I know you think that trading it at a penny and 2 cents as we're trading right now, that getting back up to 44 cents is just a monumental feat. Hey, it's not in a penny stock. Yeah, those things can get back up to $1, in a very short period of time. So I like the price action for this week. It found a lot of support at that dollar level. For me, that was crucial. So the next crucial piece is how it acts once it rallies off of this and goes back down and tries to test that dollar level again. See if there's some more support there. I don't know how many shares this thing traded. I haven't really looked at it. Let's take a look. Oh my gosh. Sorry guys. Here we go. I just happened to look over there. Okay, so anyway, sorry about that. Here's the Galafin with a weekly look. Alright, so this is the past week. I had resting orders down here at a penny a share. Okay, so we had a nice little bump up this week. We're up to 0.027 cents. I'm going to put more resting orders in at a penny. Let this thing run up and see if it comes back down and catches them. And again, like I said, I expect to lose everything, but just in case, I'm willing to toss a little bit of money out there for a lottery ticket. So anyway, I like the price action this week. We'll just keep watching this thing, and who knows, maybe we'll wake up one day and this thing's trading $2 or $3 a share. Never can tell. Anyway, I think just a second. Yeah, I think that's it, guys. What I want to take a look at for Sunday night, Monday morning is I'll flash up the CME. I'll look up on the CME website, take a look at when the next Fed announcement is, what the probabilities of an interest rate hike are, and we'll go from there. Again, the new trades I'm looking at is I'm looking at adding to my iron Condor in the SPX. I'm looking to do that Monday. I'd really like to do it on a down move. I'm looking at selling more puts in the S&P futures if we get scenario 1 for me, which is 30 handles down Monday. I know that seems like a far stretch, but we'll see. And I'm really anxious to add to the crude trade, add a little bit to the crude strangle. So those are the new things I'm looking at. Anyway, we'll guys have a nice weekend, and we'll talk to you again either Sunday night or definitely first thing Monday morning. This is BA signing out.